Welcome to the cost calculation revolution. Alright, let's get this bread. And I mean that literally because we're about to learn how to calculate exactly what that bread costs to make, deliver, and profit from. Welcome to job order costing, where we're about to fundamentally transform how you see every customized product and service in your life. I know you're probably watching this at 2 a.m. with your third energy drink. Or maybe you're that person who actually watches lectures at normal speed during daylight hours. Respect either way. But here's what I promise you. By the end of this session, you'll never look at your custom Starbucks order, your personalized Netflix recommendations, or even your group project dynamics the same way again. This isn't just about debits and credits. This is about understanding the DNA of how businesses actually track what things cost when every single order is different. We're talking about the accounting system that Tesla uses for each custom Model S, that your tattoo artist uses for that sleeve you're saving up for, and that literally every service business from law firms to music studios uses to figure out if they're making money or just making mistakes. I know you all learn differently. Some of you are visual TikTok learners who need to see it to believe it. Others are spreadsheet warriors who live for the formulas, and some of you just need stories that actually make sense. That's why I'm going to speak all your languages today. I'll give you the memes, the Excel tricks, the real company drama, and the actual numbers that matter. When I explain predetermined overhead rates, I'll connect it to your Spotify algorithm, your gaming inventory systems, and the traditional textbook approach. Because learning accounting isn't one size fits all, just like job order costing isn't one size fits all. Think of me as your accounting translator. I learned your learning language so I can teach you the business language. Whether you're that student who color codes everything, the one who learns by doing, or the person who needs to know the why behind the why, I've got you covered. No cap, we're going to make this make sense in ways your textbook could never. Whether you're watching at 2 times speed for review or pausing every 5 seconds to take notes, this recording is designed for your learning style. Grab your calculator, or honestly, just your phone calculator app because who owns a real calculator anymore, and download the practice materials linked below. If you're a visual learner, I've loaded this presentation with diagrams that actually make sense. If you're more analytical, wait until you see the formulas broken down into TikTok simple steps. And if you're somewhere in between, like most of us, you're about to get the best of both worlds. The slides are numbered and time-stamped, so when you inevitably zone out thinking about what you're going to DoorDash later, it's giving decision fatigue. I know. You can jump right back to where you lost focus. First time through, keep it at normal speed and let it marinate. Reviewing for the exam. 1.5x works perfectly unless you're one of those chaos agents who watches everything at 2x. You do you, bestie. Here's what's about to happen. I'm going to explain every concept through your world first, your apps, your streaming services, your daily financial anxiety, then connect it seamlessly to job order costing. We're not starting with formulas, we're starting with why Travis Scott's McDonald's meal needed its own cost calculation separate from a regular Big Mac. We're going to talk about why every Tesla off the production line has its own cost story, even though they look identical. And yes, we're absolutely going to discuss why your custom Chipotle bowl with double meat and guac, you bougie, I see you, needs different cost tracking than the person who just gets a basic chicken bowl. This is about understanding the accounting behind everything customized in your life, from your personalized AirPods engraving to Drake's custom jet interior. By the time we're done, you'll understand job order costing better than some people working in accounting right now, and that's not even hyperbole. That's just facts. The math is about to be mathing, the costs are about to be costing, and your understanding is about to level up exponentially. Learning objectives, your achievement unlocked preview. Let me break down what we're about to unlock today, and I'm using unlock intentionally because each of these learning objectives is literally a new level in your accounting game. First up, LO1, computing a predetermined overhead rate, or POHR, if you're into abbreviations that sound like a Pokemon. This is basically teaching you how to predict the future of costs. Imagine if you could calculate exactly how much that spring break trip is going to cost before you even book the Airbnb. That's POHR energy right there. We're going to learn the formula, but more importantly, we're going to understand why companies can't just wait until the end of the year to figure out their costs. Spoiler alert, it's the same reason you can't wait until after the semester to figure out if you can afford textbooks. Tesla doesn't wait until December 31st to know if they're profitable on each Model 3. They need that information in real time, just like how you need to know if you can afford that concert ticket before it sells out in 0.3 seconds. LO2 is where we actually apply that overhead rate to specific jobs, and this is where it gets spicy. It's like when Spotify Wrapped calculates your listening habits. They're applying rates to your actual activity. We're going to see how companies take that predetermined rate and multiply it by actual activity to assign costs to specific jobs. Think of it like how Uber calculates surge pricing, but in reverse. We're figuring out the cost, not the price. When Bad Bunny's team calculates the cost of his world tour, they're applying overhead rates to each concert venue. When that local bakery makes your custom birthday cake with the embarrassing photo printed on it, they're applying overhead to your specific order. This isn't theoretical. This is literally happening every time you customize anything, from your Starbucks order with 13 modifications to your Netflix viewing history creating a custom algorithm just for you. LO3 and LO4 are about computing total and unit costs. But here's where we level up. LO3 uses a plant-wide rate. Think of it like having one Wi-Fi password for your entire apartment complex. While LO4 uses multiple departmental rates, like having different passwords for different floors. More accurate, but more complex. This is the difference between Planet Fitness's simple pricing model and Equinox's complicated tier system. We'll see why Amazon uses departmental rates. Their warehouse costs are totally different from their AWS server costs, while your local coffee shop might just use one plant-wide rate because, let's be honest, it's all just coffee and vibes. Warren Buffett's Berkshire Hathaway uses multiple rates across their subsidiaries, from See's Candies to GEICO Insurance, because candy production and insurance claims have literally nothing in common cost-wise. LO5 is the grand finale where we use job cost sheets to track ending inventory and cost of goods sold. And this is where everything comes together like the Avengers assembling, but for accounting. These job cost sheets are like the receipts you definitely should be keeping for your taxes, but probably aren't. They become the subsidiary ledger. Think of it as the detailed story behind the summary. It's like how your screen time shows you the summary of 8 hours on your phone, but then breaks it down to show you spent 6 hours on TikTok. No judgment. We've all been there. When Apple reports their inventory on their balance sheet, those numbers come from thousands of job cost sheets. When your favorite small business on Etsy calculates their profits, they're using these sheets to track every custom order. By the end of this section, you'll understand how Frank Ocean can track the cost of each blonde vinyl variant and why Supreme can tell you exactly how much that brick cost them to make. Yes, they really sold a brick for $200 and yes, people bought it. Okay, so job order costing is basically the accounting system for anyone who's ever said, "Can I get that customized?" It's the cost tracking method for the "I'm not like other customers" energy we all have. Let me translate this 5 different ways until one clicks perfectly for you. For my gamers, job order costing is like crafting unique items in Minecraft, where each build has different materials and time invested. You can't just copy-paste the cost. Each creation is its own financial journey. For my chronically online people, it's like how every TikTok video has different production costs. Some are just you pointing at text. Others involve 13 costume changes and professional lighting. The platform needs to track each creator's costs separately, not just throw everyone into one big cost bucket. For my food delivery addicts, imagine if DoorDash had to calculate the actual cost of delivering your specific order with your 12 special instructions versus someone who just orders a simple burger. That's job order costing energy, used for unique or customized jobs. And when they say jobs, they don't mean jobs like your internship where you pretend to look busy. They mean production jobs, service jobs, any situation where what you're making or doing is distinctive enough to track separately. This is cost accumulation per job. An accumulation is just a fancy way of saying adding stuff up as we go. Think of it like your Venmo transactions for a group trip. You're accumulating costs for that specific vacation, not mixing them with your daily coffee purchases. When Marvel makes a movie, each film is a job with its own cost accumulation. Black Panther's costs don't get mixed with Spider-Man's costs, even though they're both Marvel productions. It's the same reason why Drake's album production costs are tracked separately from his tour costs. Same artist, completely different jobs with completely different cost structures. This is the opposite of process costing, which we'll learn about later and which is for mass production, where everything's the same. Think of every iPhone 15 Pro Max rolling off the assembly line. But job order costing? This is for when things are special, unique, one of a kind, or at least kind of a kind. It's for businesses that can't just multiply a standard cost by the number of units, because every unit is different. Your tattoo artist uses job order costing because that butterfly on your ankle takes different time and materials than the full sleeve on the person before you. Law firms use it because defending a parking ticket isn't the same as a murder trial, thankfully different billing rates too. Even your campus coffee shop might use it for custom drinks. That person who orders a venti iced, skinny hazelnut macchiato, sugar-free syrup, extra shot, light ice, no whip, is definitely a different job cost than someone who just says coffee black. The key insight here, and this is the tea nobody spills in your textbook, is that job order costing exists because customization is profitable. Companies charge premium prices for customized products and services, but they need to know if those premiums actually cover the extra costs. Nike ID custom shoes cost more than regular Nikes, but Nike needs job order costing to ensure they're not losing money on that customization. It's giving personalization premium, and companies need to track if that premium is worth it. When Beyoncé had that custom Versace outfit made for Coachella, Versace used job order costing to track every crystal, every hour of hand sewing, every design revision. The historical perspective is fascinating too. Job order costing has been around since medieval times when craftsmen needed to track costs for custom armor and weaponry. Today's version just replaced cost per suit of armor with cost per consulting engagement or cost per Netflix original series. The principle remains: when every job is different, you need a costing system that recognizes and captures those differences. When is job order costing used? The perfect storm of customization. Let's talk about when companies actually use job order costing, and it's not as random as your FYP algorithm, although sometimes it feels like it. The magic formula is many different products, low production volumes, and high variation between products. It's giving boutique energy rather than mass production vibes. Think of it like the difference between a custom PC build and buying a MacBook off the shelf. The custom PC builder needs job order costing because every build is different. Different graphics cards, different RGB lighting setups, because Apparently everything needs rainbow lights now, different cooling systems. Apple's standard MacBooks, that's process costing territory. But here's where it gets interesting. Even Apple uses job order costing for their special edition products and custom enterprise orders. It's not about the company, it's about the specific production situation. Customized production or services is where job order costing really shines, and by shines, I mean it literally illuminates the true cost of customization. This is why your local bakery charges $200 for a custom wedding cake, but only $30 for their standard birthday cake. They're tracking the actual costs of your rustic naked cake with edible flowers and gold leaf. We get it, your aesthetic. Service businesses are absolutely living in job order costing land. Your therapist, job order costing for each patient's treatment plan. Your mechanic, different cost for your Honda Civic's oil change versus that Tesla's battery replacement. Even your professor, hey, that's me, theoretically uses job order costing if we track time spent on different classes. Though let's be real, we're not that organized. The point is, whenever the service varies significantly, you need job order costing to know if you're making money or just making yourself busy. High variation is the key trigger for job order costing, and variation is everywhere in today's economy. It's not just about different products, it's about different versions, different specifications, different customer requirements. Boeing doesn't just make planes, they make specific configurations for each airline. Southwest 737s are different from United 737s, even though they're the same model. It's like how every Subway sandwich is theoretically customized, but let's be honest, we all just get the same thing every time. But Subway still needs to track costs per sandwich type to know if that extra everything person is actually profitable. SpaceX uses job order costing for each rocket launch because even though they're reusing rockets, sustainable queen behavior, each mission has different requirements, different payloads, different destinations. One launch might be putting satellites in orbit, another might be sending supplies to the ISS, another might be launching a Tesla Roadster into space because Elon Musk thought it would be funny. Iconic, but expensive. The managerial insight here is recognizing when your business model demands job order costing versus when you're overcomplicating things. Some businesses try to use job order costing when they really don't need it, like if Chipotle tracked every single bowl individually instead of using standard portions and prices. That's just creating work for yourself, and not the good kind of work that gets you promoted. Warren Buffett's philosophy applies here. Keep it simple, but not simpler than it needs to be. If your products or services are genuinely different enough to justify different pricing, you need job order costing. If you're just trying to feel special, maybe stick with process costing and save yourself the headache. The test is this. If a customer asks, "How much will this cost?" and your answer is, "It depends on what you want," congratulations, you need job order costing. If your answer is check the menu board, you probably don't. Although with inflation these days, even the menu board prices feel like they're customized to hurt our feelings specifically. Real-world examples, from Boeing to your favorite musician. Let's dive into the companies actually using job order costing, and plot twist. It's basically everyone doing anything remotely interesting or creative. Manufacturing examples hit different when you realize these aren't just factories. They're customization kingdoms. Boeing is the ultimate job order costing flex. Every single aircraft is a unique job. When Emirates orders an A380 with custom first-class suites that cost more than your college tuition, that's a job. When Spirit Airlines orders the most basic plane legally allowed to fly, allegedly, that's a different job. with very different costs. Boeing tracks everything from the gold-plated fixtures and Saudi Prince private jets to the standing room-only configurations that Ryanair keeps threatening to implement. Each plane isn't just a plane, it's a multi-million-dollar custom project that takes years to complete. Bechtel, the construction giant you've probably never heard of but who's built everything from the Hoover Dam to Saudi Arabia's new Neom City, is job order costing on steroids. Each construction project is its own financial universe. Building a nuclear power plant in Georgia? That's one job with probably 1,000 sub-jobs. Constructing the Channel Tunnel between England and France? Different job, different costs, different everything. It's like how your campus is constantly under construction. Seriously, will they ever finish? And each project, the new student center, the parking garage nobody asked for, the administrative building that definitely didn't need marble floors, is tracked separately. Vistaprint seems simple, business cards and stuff, but every custom order is its own job. Your startup's holographic business cards with QR codes? Different cost than Karen from accounting's traditional cards with clip art. Even that memorial bench on campus with the oddly specific quote had its own job order cost sheet. Service industry examples are where job order costing gets really relatable because this is literally your future career. Law firms are the ultimate job order costing reality show. Defending someone for a speeding ticket? That's maybe a $500 job. Defending a corporation in a billion-dollar antitrust case? That's millions in billable hours. And yes, they track every 6-minute increment. 0.1 hour increments, because lawyers are extra like that. When Johnny Depp's legal team was battling it out with Amber Heard's team, each side was running their own job order costing marathon. Accounting firms like Deloitte and PwC use job order costing for each audit, each tax return, each consulting project, your simple 1040 EZ. Different job cost than Apple's international tax optimization strategy that probably required a small army of CPAs. Healthcare is wild with job order costing. Your annual checkup is one job, someone's heart surgery is another job, and that person who comes to the ER because they accidentally got something stuck somewhere, that's definitely its own job with its own special billing code. But here's where it gets actually interesting for your generation. The creator economy is entirely job order costing based. Every sponsored Instagram post is a job. When Emma Chamberlain does a partnership with a coffee brand, that's tracked as a specific job with cost for photography, editing, posting, engagement management, music production, absolutely job order costing. When Drake drops an album, each song is technically its own job. Different producers, different features, different studio time. God's Plan had different costs than In My Feelings, even though they're on the same album. Travis Scott's Astroworld album had different costs for each track, and his concerts are separate jobs entirely. Your favorite YouTuber? Each video is a job. Mr. Beast's $1 versus $1 million hotel room video had significantly different costs than his I counted to 100,000 video, though both probably cost more than our annual salaries. Even OnlyFans creators, yes, we're going there, use job order costing for custom content versus their standard subscription posts. The key takeaway? If you're creating anything unique, distinctive, or customized, you're in job order costing territory, whether you realize it or not. Cost flow, direct costs, hit different. All right, let's talk about how costs actually flow through the system, starting with direct costs, the costs that are basically wearing name tags saying, "Hi, I belong to job number 1247. Direct materials, DM, and direct labor, DL, are the VIPs of job order costing, because they can be directly traced to specific jobs without any complicated allocation drama. It's like when you split the Uber to the party. You know exactly who was in the car and exactly how much each person owes. No ambiguity, no, but I only went halfway arguments. Direct materials are the physical ingredients that become part of the product. The leather in your custom Air Forces, the paper in your printed thesis that you'll never look at again, the overpriced lumber that's making your landlord rich through renovations. These materials get traced directly to jobs, like how your DoorDash order gets traced directly to your credit card, painfully directly if we're being honest. Think of direct materials like the ingredients in your Chipotle bowl. They can literally point to which rice, beans, meat, and that extra guac, because you're worth it, went into your specific order. When Tesla builds a Model S Plaid, they know exactly which battery pack, which motors, which carbon fiber spoiler went into that specific vehicle. It's not like they're guessing or averaging. They scan barcodes, track serial numbers, and know precisely what materials went where. This is why, when there's a recall, they can tell you exactly which VIN numbers are affected. They've been tracking direct materials since day one. The recording industry does this too. When Beyoncé records Renaissance, they track which studio time, which session musicians, which producers worked on each track. Those are direct costs, baby, and they're not playing around. Direct labor is the human element that's specifically working on your job. And no, your emotional labor from group projects doesn't count, though it should. These are the hours that can be directly traced to making a specific product or providing a specific service. When that tattoo artist spent 4 hours on your sleeve, that's direct labor for your job. When the mechanic spent 3 hours figuring out that weird noise your car makes, it's probably nothing. Or everything. That's direct labor. The key is traceability. We can point to these hours and say, yep, that was specifically for this job. It's like how your screen time can tell you exactly how many hours you spend on TikTok versus Instagram. Traceable, undeniable, slightly embarrassing. In professional services, this gets tracked to the minute. Lawyers tracking billable hours, consultants logging time to specific clients, even your therapist tracking your session time, all direct labor being traced to specific jobs. The beautiful thing about direct costs is they're honest. They don't require any allocation gymnastics or overhead spreading. They're the what you see is what you get of cost accounting. When Apple assembles an iPhone, they know exactly which A17 Pro chip and which display panel went into unit number 73,829,472. When your favorite local restaurant makes your custom pizza with 17 toppings because you're indecisive, they know exactly which ingredients and how many minutes of pizza-making labor went into your culinary chaos. This direct traceability is crucial for job order costing because it forms the foundation of accurate cost calculation. Without accurate direct cost tracking, everything else falls apart like your sleep schedule during finals week. The historical perspective here is interesting too. During World War II, defense contractors had to track direct materials and labor so precisely that it revolutionized cost accounting. They were building unique aircraft and ships, each with specific configurations, and the government wanted receipts. That level of detail tracking they developed, that's what evolved into today's job order costing systems that track your custom Starbucks order with military precision. Cost flow, indirect costs, and the allocation game. Now we're entering the danger zone. Manufacturing overhead, MOH, aka indirect costs, aka the costs that refuse to wear name tags and identify which job they belong to. These are the costs that are like that friend who shows up to the party uninvited, but you still have to feed them. Manufacturing overhead is allocated, not traced, and that word allocated is doing a lot of heavy lifting here. It's giving, we'll figure out who owes what later energy, except in accounting, we actually have to figure it out with math. Indirect materials are materials used in production, but not directly traceable to specific jobs, like the oil that keeps the machines running, the sandpaper that smooths multiple products, or the coffee that keeps factory workers functional. It's like the Wi-Fi at Starbucks. Everyone uses it. But how do you charge each customer for their specific Instagram scrolling? Indirect labor is even more chaotic. These are the people working in production but not on specific jobs. The factory supervisor walking around making sure nobody's on TikTok. Indirect labor. The maintenance crew keeping the equipment from falling apart. Indirect labor. The quality control person rejecting products that aren't up to standard. Indirect labor. It's like your RA in the dorms. They're necessary for the operation, but you can't trace their work to any specific residence experience. When Tesla's Gigafactory has security guards, janitors, and plant managers, those costs need to be spread across all the vehicles being produced. But how? That's where allocation comes in, and allocation is basically educated guessing with extra steps. We take these indirect costs and spread them across jobs using some logical basis, hoping we're being fair, knowing we're probably not perfect, but doing our best with the information we have. The allocation process is where accountants become part mathematician, part philosopher, part fortune teller. We need to find an allocation base, something we can measure that hopefully relates to how much overhead a job actually uses. Common allocation bases include direct labor hours, because more labor usually means more overhead, machine hours, because machines be expensive to run, or direct labor cost, because why not make it more complicated? It's like trying to split the Airbnb cost for spring break when some people stayed extra nights, some people brought extra guests, and someone definitely ate more than their share of the communal groceries. You need a system, even if it's not perfect. When Drake's recording label allocates studio overhead costs, they might use studio hours as the base. When Boeing allocates factory overhead, they might use direct labor hours. The choice of allocation base can literally change whether a job looks profitable or not, which is why companies spend stupid amounts of time arguing about this. Here's the tea that your textbook won't spill. Overhead allocation is inherently unfair, and everyone knows it. It's like group project grades. Someone's getting credit for work they didn't do, and someone else is getting shortchanged. A simple job might get charged too much overhead because it happened to use a lot of direct labor hours, even though it barely used any factory resources. A complex job might get charged too little because it was super automated. This is why some companies have moved to activity-based costing ABC, which we'll talk about later, which tries to be more accurate but is also more complicated than your relationship status. The historical context is that overhead used to be tiny compared to direct costs. Back in the day, factories were mostly labor and materials. Now, overhead can be massive. Amazon's fulfillment centers are mostly overhead. Robots, conveyors, software systems, warehouse costs. The actual pickers and packers. That's a relatively small part. This shift has made overhead allocation one of the most important and contentious parts of cost accounting. Warren Buffett once said, "Beware of geeks bearing formulas," and honestly, overhead allocation formulas are exactly what he was talking about. The job cost sheet, your receipt for everything. The job cost sheet is basically the ultimate receipt, the comprehensive Spotify Wrapped of production costs, the detailed story of every dollar spent on a specific job. This isn't just some random form. It's literally the subsidiary ledger for work in process inventory, which is a fancy way of saying it's the detailed backup for those big numbers on the balance sheet. Think of it like your detailed credit card statement versus just knowing your total balance. The balance is nice, but when you need to dispute that charge from 6 months ago, you need the details. Job cost sheets track direct materials, direct labor, and manufacturing overhead for each specific job, creating a financial biography of every product or service. It's like how your iPhone tracks everything: screen time, battery usage, app data, except this is tracking money, and unlike your screen time, you actually want to look at these numbers. When a company starts a job, they literally create a new job cost sheet, like creating a new playlist for a specific mood. Job number 1247 gets its own sheet. Job number 1248, different sheet. It's not like they're sharing. This isn't a our costs situation. This is a your costs, specifically your costs situation. Every time materials get requisitioned for that job, it gets recorded on that job's cost sheet. Every time a worker clocks time to that job, boom, on the sheet. Every time overhead gets allocated, using whatever magical formula they've decided on, you guessed it, on the sheet. By the time the job is done, you've got a complete financial story. Tesla's job cost sheet for a custom Model S might show $30,000 in batteries, direct materials, $2,000 in assembly labor, direct labor, and $5,000 in allocated overhead, giving you that $37,000 cost that they'll mark up to $100,000 because capitalism. The subsidiary ledger aspect is crucial, and it's where the accounting gets actually beautiful. Yes, I just called accounting beautiful. Deal with it. All these individual job cost sheets add up to equal the work in process inventory balance on the balance sheet. It's like how all your individual Venmo transactions add up to your total spending, except companies actually track this properly instead of just crying when they see the total. If the balance sheet shows $1 million in WIP inventory, there better be job cost sheets that add up to exactly $1 million, or someone's about to have a bad day. This is what auditors check. They're not just trusting the total, they're digging into the details like that friend who screenshots receipts. When PwC audits Boeing, they're not just accepting that Boeing has $50 billion in WIP inventory. They're tracing that back to specific airplane job cost sheets. Flight number N12345 being built for United, that's got a job cost sheet. The military contract for those fighter jets, different sheets, probably classified, definitely expensive. The evolution of job cost sheets is low-key fascinating if you're into that kind of thing, and after this lecture you will be. They used to be literal sheets of paper. Imagine the filing cabinets. Now they're digital, integrated with ERP systems, updating in real time, accessible from anywhere. When your tattoo artist tracks your sleeve progress on their iPad, that's a modern job cost sheet. When the contractor renovating your overpriced apartment tracks expenses in QuickBooks, job cost sheet. Even your group project probably needs a job cost sheet to track who actually did what, though good luck getting Kevin to accurately report his hours. The modern versions can include photos, link to purchase orders, integrate with time tracking apps, and automatically calculate overhead allocation. It's giving spreadsheet on steroids energy. Some companies even have job cost sheets that customers can access, like when you order custom furniture, and can track the production progress and costs. Transparency king behavior, honestly. The key insight: job cost sheets aren't just accounting documents. They're management tools, pricing guides, and the financial DNA of every customized product or service in the economy. Visual cost flow diagram, following the money. Let me paint you a picture of how costs flow through the system, and it's basically like tracking your money through a weekend in Vegas. You need to know where it started, where it went, and where it ended up. Spoiler, probably not where you planned. The visual flow goes raw materials arrow, work in process arrow, finished goods arrow, cost of goods sold, and each arrow represents a journal entry, which is just accounting's way of leaving receipts for everything. Think of it like your food's journey through your favorite restaurant. Ingredients in the walk-in cooler, raw materials, stuff being cooked on the line, work in process, plated dishes waiting for pickup, finished goods, and food that's been served and eaten, cost of goods sold. Each stage has its own vibe, its own tracking, and its own drama. Raw materials inventory is where everything starts, like your closet before you decide what to wear. Full of potential, probably overstocked, definitely containing things you forgot you bought. When materials get requisitioned for a specific job, they leave raw materials and enter work in process. It's like when you finally pull that outfit together, those individual pieces are now committed to a purpose. The job cost sheets are literally tracking this journey. When Tesla pulls batteries from their raw materials inventory for a specific Model 3, that cost flows from RM to WIP, and job number 420069, nice, gets charged for those specific batteries. This isn't some theoretical transfer. This is real money moving through real accounts, creating an audit trail that would make the IRS proud. Work in process is where the magic happens, where raw materials meet labor and overhead to create something worth more than its parts, hopefully. WIP is like your Spotify playlist in progress. You're adding songs, costs, removing things that don't fit, trying to create something coherent. Every job in WIP has its own job cost sheet tracking its accumulating costs. Some jobs chill in WIP for days, custom furniture, some for months, buildings, some for years, those airport construction projects that never seem to end. While they're in WIP, costs keep accumulating like your student loan interest, relentlessly and somewhat depressingly. Direct materials flow in from RM inventory, direct labor flows in from workers' time cards, and overhead flows in from the allocation formula we're about to learn, which is basically accounting's version of trust the process. When a job is finally complete, it makes its grand exit from WIP to finished goods inventory, like graduating from college but for products. The job cost sheet gets totaled up, stamped complete, and the full cost transfers to finished goods inventory. This is the moment of truth. You finally know exactly what this thing costs to make. Then when it sells, boom, it flows from finished goods to cost of goods sold on the income statement. This is where costs go to die, or rather, where they get matched against revenue to calculate profit. It's the accounting circle of life, and it moves us all. The visualization matters because when you can see the flow, you can spot where things might go wrong. Materials stuck in raw materials too long, that's cash tied up doing nothing. Jobs sitting in WIP forever, that's probably a project management issue. Finished goods not moving to COGS, that's inventory nobody wants to buy. Looking at you, every store still trying to sell fidget spinners. Understanding this flow is like understanding how Netflix tracks content costs from production to streaming. Every dollar has a journey, and job order costing is the GPS. Measuring direct materials. Part 1. The requisition hustle. Let's talk about requisition forms, which sounds boring but is actually the accounting equivalent of sliding into someone's DMs. You're making a formal request for something you want, and you need approval before you get it. A materials requisition form is basically a permission slip for adults who want to take materials from the warehouse for a specific job. It's like when you text your roommate asking if you can use their HBO Max password, except this is formal, documented, and definitely won't get you kicked off mid-episode. Every requisition form has the job number, the materials needed, the quantity, the cost, and signatures from people who apparently have nothing better to do than sign forms all day. But these forms are crucial because they create the paper trail, or digital trail, because trees deserve better, that connects specific materials to specific jobs. When a production worker needs materials for job number 1337, they can't just walk into the warehouse and grab stuff like it's a free sample day at Costco. They need to fill out a requisition form that basically says, hey, I need these specific materials for this specific job, and here's my supervisor's signature, proving I'm not just building a fort in the break room. The form includes the type of materials, 10 pounds of steel, 50 yards of fabric, 17 gallons of that specific shade of beige that corporate insists on. the unit cost, and the total cost. It's giving formal request energy, but it's necessary because without this documentation, you'd have no idea where your materials went. It would be like trying to track your Uber rides without the app, theoretically possible, but practically chaos. The requisition process is where the direct materials cost tracking actually begins. When that form gets approved and materials get issued, the job cost sheet gets updated immediately. It's like when you order DoorDash and your credit card gets charged immediately. No hesitation, just immediate financial pain. If Tesla needs a specific battery pack for a custom Model S build, the requisition form documents that battery pack number ABC123 worth $10,000 was issued to Job number 789. This isn't some general "we used about this much" situation. This is specific, traceable, and legally binding. The warehouse keeps a copy, accounting keeps a copy, production keeps a copy, and somewhere a tree is crying. But this documentation is what allows companies to track exactly what went into each job, which is essential for pricing, profitability analysis, and explaining to customers why their custom whatever costs so much. Here's what actually happens in practice that your textbook glosses over. Requisition forms are often digital now, integrated with inventory management systems, and can trigger automatic reordering when supplies get low. It's like how your Amazon Subscribe and Save knows when you're about to run out of protein powder. The system is watching, always watching. Some companies use RFID tags or barcodes, so materials can be tracked without paperwork at all. When a worker takes materials, they scan them out to a specific job, and the system automatically updates the job cost sheet, the raw materials inventory, and probably sends a notification to 3 different managers who all think they're in charge. The historical perspective is that requisition forms date back to the Industrial Revolution, when factories needed to control material usage because workers were apparently just taking stuff home, the original borrowing from work. Today's systems are more sophisticated, but the principle remains. If you want materials for a job, you better document it, because accounting is watching, and accounting never forgets. Posted to the job cost sheet. Now that we've requisitioned materials like responsible adults who follow procedures, it's time to post these costs to the job cost sheet, and posting is just accounting's fancy word for writing it down in the right place. When materials get posted to a job cost sheet, it's like adding ingredients to your recipe app. You're building a complete picture of what's going into this creation. The job cost sheet has a specific section for direct materials where every requisition gets recorded with the date, requisition number, description, and cost. It's basically the accounting equivalent of your Instagram story highlights, organized, categorized, and telling a complete story about that job's material journey. Each posting increases the job's cost, building toward the final total that'll make you understand why custom things cost so much. The posting process is where the rubber meets the road, or more accurately, where the cost meets the sheet. Let's say you're tracking Job number 2024 for a custom wedding dress because someone decided they needed 10,000 hand-sewn crystals. Every time materials get requisitioned, the silk fabric, $500, the crystals, $2,000, the thread that better be made from unicorn hair at these prices, $50. Each requisition gets posted to that job's cost sheet. By the time you're done, you might have 20 different material postings, creating a detailed cost story that explains why this dress costs more than a car. It's like your Uber ride history for a night out. Each ride is posted separately, and by the end, you're questioning your life choices. But at least with job cost sheets, you can see exactly where the money went. The posting isn't just about recording, it's about accumulation and tracking. Each posting adds to the running total of direct materials for that job. It's like how your Spotify Wrapped tracks every minute of every song. The individual plays get posted to your annual total, creating that embarrassing revelation that you listened to that one song 847 times. For companies, this accumulation is critical because it shows the true material cost of the job. When Boeing builds a 787 Dreamliner, they're posting thousands of material requisitions to that job's cost sheet. Every bolt, every panel, every seat that costs more than your monthly rent, it all gets posted. By the time they're done, they might have $100 million in direct materials posted to that single job. The accumulation tells the story of the build, from the first rivet to the gold-plated first-class lavatory fixtures, because apparently regular fixtures aren't fancy enough for people paying $10,000 for a flight. What's really interesting is how posting to job cost sheets has evolved with technology. It used to be literal posting, someone physically writing numbers in a ledger, probably by candlelight while wearing one of those green visors. Now, it's automatic, instantaneous, and integrated. When Amazon's warehouse worker scans an item for a specific customer order, that posts immediately to that order's job cost sheet. When your local bakery adds fondant to your custom cake, their point-of-sale system posts that material cost to your order. Even restaurants with tablets for ordering are essentially posting your modifications to your meal's job cost sheet in real time. The modern posting process can include photos, link to supplier invoices, and even flag unusual costs for review. It's like having a financial Instagram story for every job, documenting everything, creating a narrative, and providing receipts for anyone who wants to see them. The key insight: posting to job cost sheets isn't just bookkeeping, it's creating the financial DNA of every custom product or service. Without accurate posting, you have no idea if you're making money or just making things. Measuring direct labor, time is money, literally. Time tickets and time records are about to become your new obsession because they're literally how we track the time is money, cliche in actual monetary terms. A time ticket is like your screen time report, but for work, and instead of showing you spent 6 hours on TikTok, it shows you spent 6 hours on job report 242. Workers track their time to specific jobs, and this isn't just I worked 8 hours today energy. This is I spent 2.5 hours on job A, 3 hours on job B, 1.5 hours on job C, and 1 hour pretending to look busy, level detail. Every minute has to be accounted for, like when your phone tracks your location, and you have to explain why you were at your ex's apartment complex. You were just turning around in the parking lot, obviously. These time records become the basis for charging direct labor costs to specific jobs, and they're way more detailed than you'd expect. Modern time tracking has evolved from punch cards to apps that would make your productivity-obsessed friend jealous. Workers might use biometric scanners, fancy fingerprint stuff, mobile apps with GPS tracking, Big Brother energy but make it accounting, or even RFID badges that automatically track when you enter different work areas. It's like how your student ID tracks when you enter the dining hall, except this is tracking billable hours. When a Tesla technician works on a custom configuration, they clock in to that specific job number. When they switch to a different car, they clock out of one job and into another. It's giving every moment must be productive vibes, which is honestly toxic but necessary for accurate costing. Law firms have been doing this forever, tracking time in 6-minute increments because apparently lawyers bill by the 10th of an hour like they're speedrunning capitalism. The accuracy of time tracking directly impacts job profitability calculations, and this is where things get spicy. If workers forget to clock into specific jobs, or if they're creative with their time reporting, we've all been there with our timesheet, the job costs get distorted. Imagine if Netflix didn't accurately track what you actually watched and just guessed your viewing habits. Your recommendations would be chaos. Same with job costing. If the time tracking is wrong, everything downstream is wrong. This is why companies invest stupid amounts of money in time tracking systems. When Beyoncé's recording renaissance, every hour in the studio is tracked to specific songs. The producer's time, the engineer's time, the session musician's time, it all gets tracked and allocated to specific tracks. Alien Superstar might have taken 100 hours of studio time, while Pure Honey took 50 hours. And that difference matters for understanding the true cost of each song. Here's the tea that nobody talks about. Time tracking is inherently problematic because humans aren't machines, despite what your manager might think. What happens when you're thinking about job A while working on job B? What about the 10 minutes between jobs when you're getting materials or setting up? What about when you're training someone while working? Does that time count as direct or indirect? Companies handle this differently, and the choices they make can significantly impact job costs. Some companies use standard labor times. Every oil change is assumed to take 30 minutes regardless of actual time, while others track actual time to the second. The gig economy has made this even more complex. When an Uber driver has multiple passengers pooling, how do you allocate their time? When a freelance graphic designer is working on multiple projects simultaneously, because multitasking is a generational skill at this point, how do they accurately track time to each job? The historical context is that time tracking started in factories during the scientific management era, when Frederick Taylor was literally timing workers with a stopwatch like some kind of productivity stalker. Today's systems are more sophisticated, but the goal remains the same. Figure out how much labor cost belongs to each job, so we know if we're making money or just staying busy. Why allocate overhead, the necessary evil? Let's talk about why we have to allocate manufacturing overhead in the first place. And spoiler alert, it's because overhead costs are like that group project member who contributes, but you can't quite pinpoint what they actually did. Manufacturing overhead is diverse, everything from electricity to factory supervisors' salaries, and largely fixed. The rent is the same whether you make one product or 1,000, which means we can't just trace it directly to jobs like we did with materials and labor. It's like trying to figure out how much of your Netflix subscription cost should be allocated to each show you watch. The monthly fee is the same whether you watch one episode or binge entire seasons, but somehow we need to divvy it up. Overhead allocation is accounting's attempt to fairly distribute these shared costs across all the jobs that benefit from them. The diversity of overhead costs is actually wild when you think about it. We're talking about factory rent, utilities, depreciation on equipment, indirect materials, lubricants, cleaning supplies, the good coffee in the break room, indirect labor, supervisors, security, that person whose job nobody really understands, property taxes, insurance, and basically every cost that keeps the factory running but can't be traced to specific products. It's like all the hidden costs of living in your apartment. Sure, you pay rent, but there's also utilities, Wi-Fi, that streaming service bundle you forgot you signed up for, renter's insurance, and the inevitable maintenance fee that appears whenever something breaks. Boeing's overhead includes everything from the electricity to run the assembly line, to the salary of the executive who shows up twice a year to give motivational speeches nobody asked for. All these costs need to be allocated to specific planes, even though a 737 and a 787 might use completely different amounts of these resources. The fixed nature of most overhead makes allocation even more complicated. Your factory rent doesn't change based on how many products you make. It's like your Spotify subscription that costs $9.99, whether you listen to music 24/7 or forget you have it for 3 months. This creates a fun, annoying situation where the overhead cost per unit changes based on volume. Make more products? The overhead per unit goes down. Make fewer products? The overhead per unit skyrockets. It's giving economies of scale energy. This is why companies obsess over capacity utilization. If you're paying for a factory that can make 10,000 units but you're only making 1,000, each unit is carrying 10 times the overhead burden. It's like paying for a family Netflix plan but you're the only one using it. Technically the same cost, but the per-person cost is painful. The allocation base is supposed to be the driver that causes overhead costs, but finding the right base is like trying to find the perfect Instagram filter. There are lots of options. They all distort reality somewhat, and everyone has opinions about which one's best. Common bases include direct labor hours, because human work supposedly drives overhead, machine hours, because robots are expensive to run, or direct labor cost, because why not make it percentage-based and confusing? The choice matters immensely. Using direct labor hours might make labor-intensive jobs look expensive, while automated jobs look cheap. Using machine hours might do the opposite. It's like choosing how to split the dinner bill, by what each person ordered, accurate but annoying, equally, simple but unfair, or by some other method that'll inevitably make someone mad. Tesla might use robot hours for their highly automated production, while a craft brewery might use direct labor hours because humans are doing most of the work. Robots haven't learned to appreciate craft beer yet. The key insight is that overhead allocation is inherently arbitrary. We're trying to assign joint costs to individual products, which is like trying to assign your shared Netflix password usage to specific family members. We do our best with the information we have, knowing it's imperfect, but it's better than not allocating overhead at all and pretending products magically appear without infrastructure. POHR defined, your crystal ball for overhead costs. The predetermined overhead rate, POHR, is basically accounting's attempt at fortune telling, except instead of crystal balls and tarot cards, we use spreadsheets and historical data. The formula is deceptively simple. POHR equals estimated total manufacturing overhead divided by estimated allocation base. But don't let that simplicity fool you. This little formula is doing some heavy lifting in the cost accounting world. It's like your algorithm for predicting how much you'll spend on coffee this semester. Take your estimated total coffee budget, divide by the number of study sessions you'll have, and boom, you've got your predetermined coffee rate per study session. Except companies are doing this for millions of dollars of overhead costs, so the stakes are slightly higher than your latte budget. The predetermined part is crucial here. We're calculating this rate before the period starts, not after. It's like planning your spring break budget in January, not calculating it after you've already maxed out your credit card in Miami. Companies need to know their costs as they happen, not a year later when all the bills are paid and counted. Imagine if Tesla waited until December 31st to figure out how much overhead to charge to each car they made that year. They'd have no idea if they were profitable until after the fact, which is giving finding out your final grade after graduation energy. The POHR lets them assign overhead costs to jobs in real time, so they know immediately if that custom Model S configuration is profitable or if they're basically building cars for charity. The estimation aspect makes this inherently imperfect, and that's okay. We're not trying to be psychic, just reasonably accurate. It's like estimating how many hours you'll spend on TikTok this month. You know it'll be embarrassing, but you need a number for planning purposes. Companies look at historical data, future projections, industry trends, and probably consult a magic 8-ball before settling on their estimates. When Apple estimates their overhead for the year, they're considering everything from expected electricity costs to how many corporate jets Tim Cook will use. They're not going to be exactly right. Nobody can predict when a global pandemic will shut down factories, or when a ship will get stuck in the Suez Canal and mess up everything. But they need a number to work with, so they make their best educated guess and run with it. The beauty and curse of POHR is that it smooths out overhead costs across the year, which is both helpful and potentially misleading. Without POHR, overhead costs per unit would fluctuate wildly. December's products would bear huge heating costs while July's wouldn't. Products made during slow periods would carry massive per unit overhead, while busy period products would get off easy. It's like if your rent was allocated based on how many hours you spent in your apartment each month. December break would be cheap, but finals week would bankrupt you. POHR spreads these costs evenly, like a financial socialism for overhead costs. Every job gets charged the same rate per direct labor hour, or whatever base you're using, regardless of when it's produced. This makes pricing easier, but it also means some jobs are definitely subsidizing others. It's giving group project where everyone gets the same grade energy. Fair in theory, problematic in practice. Warren Buffett would probably have thoughts about this. He has thoughts about everything. But even Berkshire Hathaway uses predetermined rates because the alternative, waiting until year end to know your costs, is worse than being approximately right throughout the year. POHR formula setup, the mathematical model of manufacturing. Let's break down the POHR formula like we're dissecting a TikTok trend. Every component has a purpose, and understanding each part helps you master the whole. The formula y equals a plus bx looks like something from your high school algebra nightmares, but it's actually just describing how costs behave. Y is your estimated total manufacturing overhead, the big number we're trying to predict. The A represents fixed manufacturing overhead, the costs that hit the same whether you're grinding or chilling, rent, insurance, depreciation on equipment, the salary of that middle manager who sends motivational Monday emails nobody reads. The B is your variable overhead rate per unit of activity, costs that scale with production like utilities, indirect materials, and the coffee consumption that somehow increases exponentially during busy periods. X is your allocation base, the thing you're measuring to spread overhead around, like direct labor hours, machine hours, or tears shed during production. Kidding on that last one, but honestly it might be more accurate. This formula is basically saying your total overhead is your fixed costs plus your variable costs, which is giving energy until you realize how powerful this is for prediction. It's like saying your monthly spending equals your fixed expenses, rent, subscriptions, that gym membership you keep saying you'll use, plus your variable expenses, food, going out, those impulse Amazon purchases that arrive and you don't even remember ordering. Once you know this formula, you can predict total costs at any level of activity. If Tesla knows their fixed overhead is $10 million and their variable overhead is $100 per direct labor hour, they can predict overhead for any production level. Planning to use 50,000 labor hours? That's $10 million plus 100 times 50,000 equals $15 million in overhead. It's math, but make it applicable to real life. The variable overhead rate, B, is where things get interesting, because not all variable overhead is created equal. Some costs are perfectly variable. Use twice the machine hours, pay twice the electricity, while others are step variable. Hire another supervisor every 50 workers, or semi-variable, minimum utility charge plus usage. It's like how your phone plan might have a base cost plus overage charges, not perfectly fixed, not perfectly variable, just vibes. Companies spend enormous effort figuring out which costs are truly variable versus fixed, because getting this wrong means your predictions will be off. When Amazon calculates overhead for their fulfillment centers, they need to know which costs scale with packages shipped versus which costs are fixed regardless of volume. The electricity for conveyor belts, variable. The lease on the warehouse, fixed. The workers, complicated because some are permanent, fixed, and some are seasonal, variable. The historical perspective here is that this formula structure comes from the glory days of manufacturing, when economists were obsessed with cost behavior patterns. They noticed costs didn't just randomly happen, they followed patterns based on activity levels. It's like how your screen time follows patterns, higher during finals, lower during break, absolutely chaotic. During that week, you discovered a new show to binge. The y equals a plus bx formula captures this pattern mathematically, allowing prediction and planning. Modern companies have made this more complex with multiple allocation bases, step functions, and nonlinear relationships, but the basic formula structure remains. Even tech companies use this concept. When Netflix estimates their streaming infrastructure costs, they're essentially using y equals a plus bx, where x might be subscribers or hours streamed. The formula works whether you're manufacturing cars, streaming content, or making custom jewelry on Etsy. It's universal because cost behavior patterns are universal. Some costs are fixed, some are variable, and the total is predictably related to activity. Understanding this formula means understanding how businesses predict and control costs, which is literally the difference between profitability and bankruptcy. Steps to compute POHR, the 4-step recipe for success. Computing POHR is like following a recipe for the world's most important financial calculation. Skip a step or mess up the measurements, and your cost accounting souffle collapses. Step 1. Estimate the allocation base for the period. This is like estimating how many times you'll hit snooze this semester. You need a realistic number based on past behavior and future expectations. If you're using direct labor hours, you need to estimate total hours for the period. If you're using machine hours, estimate those. This isn't random guessing. It's educated prediction based on production schedules, sales forecasts, and that mysterious art of management judgment. Tesla estimates their direct labor hours based on projected vehicle production, which is based on pre-orders, market analysis, and Elon Musk's Twitter promises, the least reliable of the three. Step 2. Estimate fixed manufacturing overhead. These are your no matter what costs, the ones that show up like that friend who never brings anything to the party, but always stays until the end. Factory rent, insurance, property taxes, depreciation on equipment, salaries of permanent staff. They're all happening whether you produce anything or not. It's like your Netflix subscription during finals week when you definitely aren't watching anything, but you're still paying $15.99 for the privilege of not watching. Companies look at contracts, lease agreements, depreciation schedules, and salary commitments to nail down this number. When Boeing estimates fixed overhead for their Everett factory, the largest building in the world by volume, weird flex but okay, they're looking at millions in fixed costs before they even turn on the lights. Step 3. Estimate variable manufacturing overhead using the formula approach. This is where that y equals a plus bx formula earns its keep. You need to figure out your variable rate per unit of allocation base. How much additional overhead is incurred for each additional hour worked or machine hour used. It's like calculating your marginal cost of procrastination. Each additional hour of putting off that assignment costs you in stress, rushed work, and energy drinks. Companies analyze historical data to find patterns. If last year they spent $500,000 in variable overhead for 10,000 direct labor hours, that's $50 per hour in variable overhead. But they also adjust for expected changes, inflation, utility rate increases, that new union contract that definitely isn't making anything cheaper. Amazon's fulfillment centers calculate variable overhead rates for package handling, knowing that each additional package requires power for conveyors, wear on equipment, and probably another bathroom break for workers. Step 4. Calculate POHR by dividing total estimated overhead by estimated allocation base. This is the moment of truth, where all your estimates crystallize into a single rate that'll be used thousands of times throughout the year. It's like calculating your GPA, All those individual grades combine into one number that supposedly represents everything. If you estimated $1 million in total overhead and 50,000 direct labor hours, your POHR is $20 per hour. Simple math, massive implications. This rate gets used every time a job is costed, every time a price is quoted, every time profitability is assessed. Get it wrong, and you might be underpricing products, losing money, or overpricing them, losing customers. The pressure to get this right is why companies have entire departments dedicated to cost accounting, and why those accountants have stress levels that would make a neurosurgeon jealous. But when you nail it, when your predetermined rate accurately predicts actual overhead, that's better than getting exactly 8 hours of sleep. Rare, beautiful, and definitely worth celebrating. Example data setup, Yost Machining's numbers game. Let's dive into Yost Machining's estimates, and yes, this is a fake company, but the numbers are more real than your excuse for missing class last week. Yost is estimating their overhead for the upcoming year, and they're basically trying to predict the future without a crystal ball, just spreadsheets and coffee. They've looked at their production schedule, their sales forecasts, and probably consulted the accounting gods before coming up with their estimates. This is like when you're planning your semester budget and trying to estimate how many times you'll eat out versus cooking. Spoiler, you'll eat out way more than planned. Yost needs to estimate their direct labor hours, their fixed overhead, and their variable overhead rate, and each estimate has consequences that ripple through the entire year's costing. Their direct labor hour estimate is based on expected production volume, which is based on sales projections, which is based on market analysis, which is based on someone's educated guess about what customers will want. It's predictions all the way down, like a financial inception. Yost might be estimating 40,000 direct labor hours for the year. That seems random, but it's actually based on last year they used 38,000 hours. They're expecting 5% growth. They're adding a new product line, but they're also automating some processes. It's like estimating how many hours you'll spend studying. Last semester's total. You adjust for that one killer class you're taking, subtract for the class you're definitely coasting through, and hope for the best. Every company does this dance, from Tesla estimating labor hours for Cybertruck production, still waiting on those, Elon, to your local bakery, estimating decorating hours for wedding season. The fixed overhead estimate includes all those costs that'll happen regardless of production volume. Yost might be looking at $600,000 in fixed overhead, $200,000 in factory rent, because real estate is apparently a scam everywhere, $150,000 in equipment depreciation, machines losing value faster than your iPhone after the new model drops, $100,000 in supervisor salaries. Someone has to send those motivational emails. $80,000 in insurance, because things break and people sue, and $70,000 in other fixed costs, the mysterious other category that definitely isn't, hiding questionable expenses. These costs are locked in like your student loans. They're happening whether Yost makes one precision part or 1,000. For variable overhead, Yost needs to estimate the rate per direct labor hour. They might determine it's $10 per hour based on historical analysis and future expectations. This covers utilities that increase with production. Machines are thirsty for electricity. Indirect materials, lubricants, small tools that mysteriously disappear, safety equipment that OSHA requires, and variable portions of mixed costs. It's like how your utility bill has a base charge plus usage. The more you produce, the more these costs accumulate. If Yost analyzed last year and found they spent $380,000 in variable overhead for 38,000 hours, that's $10 per hour. But they're adjusting for inflation. expecting a 3% increase in utility rates, but also implementing some energy-efficient equipment that should reduce consumption. It's a calculation wrapped in an estimate inside a prediction, but it's the best they can do without actual time travel. The final setup, 40,000 estimated direct labor hours, $600,000 fixed overhead, $10 per hour variable overhead, which means $600,000 plus $40,000 times $10 equals $1 million total estimated overhead. Time to calculate that POHR. Example, computation. The $25 per hour that changes everything. Now we're calculating Yost Precision Machining's POHR, and this is where the magic happens, or at least where the math happens, which is basically the same thing in accounting. We've got $1 million in total estimated manufacturing overhead and 40,000 estimated direct labor hours. So the POHR equals $1 million divided by 40,000. 40,000 equals $25 per direct labor hour. That $25 isn't just a number, it's a destiny. Every time a worker spends an hour on a job, that job gets charged $25 in overhead on top of the worker's actual wage. It's like surge pricing, but predictable. You know exactly how much extra you're paying, and it happens every single time. This rate becomes the law of the land for the entire year, unless something goes catastrophically wrong and they have to recalculate, which is changing the group project topic the night before it's due energy. Let's appreciate what this $25 per hour really means. If a worker making $20 per hour spends an hour on a job, that job gets charged $20 for direct labor, the worker's wage, plus $25 for overhead, the POHR, making the total labor-related cost, $45 per hour. The overhead is literally more than the actual labor cost, which feels wrong, but is totally normal in modern manufacturing. It's like when the delivery fee and tip on your DoorDash order costs more than the actual food. The infrastructure to make it happen is expensive. This reflects the reality that modern production requires massive infrastructure. When Tesla charges overhead to a vehicle, they're not just covering the factory lights, they're covering robots that cost millions, software systems, quality control, and the army of engineers making sure the cars don't randomly catch fire. Mostly successful on that front. This $25 rate smooths out all the chaos of overhead into one manageable number. December's heating costs, covered by the $25. July's air conditioning, also $25. That week when 3 machines broke simultaneously and maintenance went into overdrive, still $25. It's like having a flat rate unlimited plan for overhead. Sometimes you use more, sometimes less, but the rate stays constant. This predictability is crucial for pricing decisions. If Yost knows a job will take 100 direct labor hours, they immediately know it'll carry $2,500 in overhead costs. They can quote prices, assess profitability, and make decisions without waiting for actual overhead bills to arrive. It's the accounting equivalent of knowing your Spotify will be $9.99, regardless of whether you listen to one song or stream 24/7. The historical context here is fascinating. Before predetermined rates, companies either waited until year-end to know their costs, imagine not knowing if you're profitable until December, or tried to trace actual overhead to jobs as it occurred, absolute chaos. The predetermined rate was a game changer, allowing real-time costing with reasonable accuracy. It's not perfect. If Yost actually uses 45,000 hours instead of 40,000, or if overhead comes in at $900,000 instead of $1 million, the $25 rate will be wrong. But it's close enough for decision-making, and that's what matters. Warren Buffett says, "It's better to be approximately right than precisely wrong," and POHR is the embodiment of that philosophy. At year-end, Yost will calculate what the rate should have been and make adjustments, but throughout the year, $25 per hour is the gospel truth. Every job cost sheet, every price quote, every profitability analysis will use this rate. It's like how your GPA calculation uses credit hours as weights. Not perfect, but systematic and useful enough to make decisions. Applying overhead, where theory meets reality. Applying overhead is where we take that beautiful POHR we just calculated and actually use it in the real world, like finally using that gym membership you've been paying for. The formula is stupidly simple. Applied MOH equals POHR times actual allocation base used. If the POHR is $25 per direct labor hour and a job uses 10 hours, boom, $250 in applied overhead. It's multiplication, but with financial consequences. This is happening constantly in manufacturing. Every time a worker clocks time to a job, overhead is being applied. It's like how every swipe of your credit card applies interest charges if you're carrying a balance, which you shouldn't be, but we all are. The application happens automatically in most systems now. Worker badges in, time starts tracking, overhead starts accumulating like student loan interest during college. The actual part is crucial here. We're using actual hours worked, not estimated or standard hours. If a job was supposed to take 10 hours, but actually took 15 because Mercury was in retrograde or whatever, we apply overhead based on the actual 15 hours. It's like when Google Maps says 20 minutes, but it actually takes 45 because of construction. You pay for the actual time, not the estimate. This creates interesting dynamics. Inefficient jobs that take longer than expected get charged more overhead, making them look even less profitable. It's adding insult to injury. Not only did you waste time, but now you're getting charged extra overhead for that wasted time. Conversely, super efficient jobs that finish quickly get charged less overhead, making them look like superstars. Tesla's most efficient assembly line workers are essentially saving the company overhead costs with every minute they shave off standard time. The application process feeds directly into job cost sheets, adding to the total cost accumulation. Every job is building up its cost story. Direct materials posted from requisitions, direct labor posted from time tickets, and now applied overhead based on the POHR. It's like how your Instagram story builds throughout the day, except instead of documenting your lunch, it's documenting costs. By the time a job is complete, you might have dozens of overhead applications, each one adding $25 or $50 or $500 to the total, depending on how many hours were worked. When Boeing builds a 787, they're applying millions in overhead across thousands of labor hours. Each technician's hour triggers an overhead application, building toward that final cost that makes you understand why planes cost $200 million. Here's what nobody tells you about overhead application. It's simultaneously precise and completely made up. Precise because we're using exact, actual hours and a predetermined rate calculated to 4 decimal places. Made up because that rate is based on estimates and allocations that are inherently arbitrary. It's like your horoscope. Very specific predictions based on completely general assumptions. A job that uses 10 direct labor hours gets exactly $250 in overhead, not $249 or $251, but whether that $250 accurately represents the overhead resources the job actually consumed, that's debatable. Maybe this job was simple and barely used any overhead resources. Maybe it was complex and consumed way more than $250 worth of supervisor attention, machine time, and utilities. The POHR doesn't care. Everyone gets the same rate. It's socialist accounting, and just like actual socialism, it works better in theory than practice. But it's still better than the alternatives, waiting until year end or trying to trace actual overhead. So we accept the fiction and move on. As long as everyone's using the same fiction, at least we're consistently wrong, which is somehow better than inconsistently right. Calculating total job and unit cost, the moment of truth. This is where everything comes together like the Avengers assembling, except instead of saving the world, we're calculating the total cost of job WR53. We're adding up all the costs we've accumulated, direct materials from all those requisition forms, direct labor from all those time tickets, and applied manufacturing overhead from our POHR calculation. It's like calculating your total spending for the semester: tuition, direct, books, direct, and all those miscellaneous expenses your parents definitely don't need to know about, overhead. Job WR53 might have $5,000 in direct materials, fancy stuff apparently, $3,000 in direct labor, skilled workers don't come cheap, and $2,000 in applied overhead, those 80 labor hours times 25 POHR. Total job cost, $10,000. That number tells us everything about what it costs to complete this specific job. But here's where it gets interesting. We usually need the unit cost, not just the total job cost. If job WR53 produced 100 units, the unit cost is $10,000 divided by 100 equals $100 per unit. This is the number that actually matters for pricing decisions, profitability analysis, and explaining to customers why custom products cost so much. It's like calculating the per-person cost of your Airbnb. The total might be $2,000, but split 8 ways, it's $250 each, unless Kevin doesn't pay his share. Classic Kevin. The unit cost is what gets compared to selling price to determine profit margin. If Yost is selling these units for $150 each, they're making $50 per unit in gross profit, which sounds good until you remember there are still selling and administrative costs to cover. It's giving revenue doesn't equal profit energy, which is a lesson too many businesses learn the hard way. The power of job order costing is that we can calculate this total cost while the job is still in progress. We don't have to wait until it's done to know if we're on track. It's like checking your grades throughout the semester instead of waiting for the final to find out if you're passing. As materials get requisitioned, labor gets tracked, and overhead gets applied, the job cost sheet shows the running total. Managers can see if a job is going over budget before it's too late to do anything about it. Hey, job WR53 is already at $8,000 and it's only 75% complete, is valuable information that can trigger intervention. Maybe they switch to cheaper materials for non-critical components, or assign more experienced workers to finish faster, or just accept that this job is going to be a loss and price future jobs higher. The calculation seems simple, but it represents hundreds of individual transactions and decisions. Every material requisition, every hour worked, every overhead application built toward this final number. When Apple calculates the total cost of a custom configured Mac Pro, the one that starts at $6,000 and can go up to $50,000 because apparently some people need that much computer, they're adding up thousands of individual cost components. The processor, the memory, the graphics cards that cost more than your car, the wheels that inexplicably cost $700. It all adds up to a total job cost that explains the eye-watering price tag. The unit cost calculation is even more critical for small businesses. That Etsy seller making custom wedding invitations needs to know if that 200 invitation order actually made money after materials, labor, and overhead. Too many small businesses fail because they price based on materials alone, forgetting about labor and overhead. They think they're making money because the materials cost $50 and they charged $100. But after adding labor and overhead, the true cost was $120. It's giving working for exposure energy, except exposure doesn't pay rent. Understanding total and unit job costs isn't just academic, it's the difference between a profitable business and an expensive hobby. Quick check problem. Test your understanding. Let's hit you with a quick check problem, because what's the point of learning if we don't immediately test whether you were actually paying attention or just scrolling TikTok with the lecture playing in the background? Here's the setup. Job number 420, nice, uses $300 in direct materials, 10 direct labor hours at $15 per hour, and we're applying overhead at $28 per DLH. What's the total job cost? This is where you pause and actually try it before I give you the answer. I'll wait. Still waiting. Okay, fine. Let's work through it together, because we both know you didn't actually pause. Direct materials are straightforward. $300 is $300. No tricks here, though in real life, there would definitely be multiple requisitions, and probably someone would forget to record one, and the cost would be wrong. But we're keeping it simple. Direct labor is 10 hours times $15 per hour equals $150. This is assuming workers actually tracked their time correctly and didn't round up to the nearest hour like we all do with study time. I studied for 4 hours equals 2.5 hours studying, 1.5 hours looking at your phone. Applied overhead is where the POHR magic happens. 10 direct labor hours times $28 per hour equals $280. Notice how the overhead, $280, is almost double the actual labor cost, $150. That's modern manufacturing for you. The infrastructure costs more than the people. Total job cost equals $300 DM plus $150 DL plus $280 applied MOH equals $730. If you got that right, congratulations. You're officially better at job costing than half the people who claim they work in business. If you got it wrong, no judgment. At least you're here learning instead of pretending you understand accounting while secretly Googling every term in meetings. This $730 represents the accumulated cost of job number 420, the number that would appear on its job cost sheet, the number that would transfer to finished goods when complete, and eventually to cost of goods sold when sold. It's the financial biography of that job, summarized in one number. Here's what this problem teaches us beyond just the math. The overhead portion, $280, is a huge part of the total cost, 38% to be exact. And it's all based on that predetermined rate we calculated before the year even started. If that POHR is wrong, this job cost is wrong. If the company estimated their overhead incorrectly, or if they're having an unusually good or bad year, that $28 rate might be way off. It's like using last year's Spotify Wrapped to predict this year's listening. Probably close, but definitely not perfect. This is why companies with job order costing obsess over their predetermined rates. Get them right, and your pricing is accurate, your profitability reports are reliable, and your managers can make good decisions. Get them wrong, and you might be losing money on every sale while thinking you're profitable, which is giving Enron energy but legal. The quick check seems simple, but it represents the entire job order costing system in miniature. Materials tracked, labor recorded, overhead applied, total cost calculated. Master this, and you've mastered the basics of job order costing. Managerial perspective. Part 1. When bad allocation ruins everything. Poor overhead allocation is like using the wrong Instagram filter. It distorts reality and makes bad decisions look good. When overhead isn't allocated properly, product costs are wrong, which means pricing decisions are wrong, which means you might be losing money while thinking you're Warren Buffett. It's the accounting equivalent of thinking you're killing it at poker, while everyone else at the table is actually letting you win small pots while taking you for everything on the big ones. Poor allocation can make profitable products look unprofitable, so you discontinue them. Unprofitable products look profitable, so you keep making them and turn your entire business strategy into an expensive guess. Let me paint you a picture of how this goes wrong. Imagine a company that makes both simple products, basic t-shirts, and complex products, custom embroidered jackets. They use direct labor hours to allocate overhead because that's what they've always done. The t-shirts take 0.1 hours of labor each. The jackets take 2 hours each. Using a $50 per hour POHR, t-shirts get $5 of overhead, jackets get $100. Seems logical, except the jackets require special machines, climate-controlled storage, quality inspections, and custom packaging, while the t-shirts are basically print and ship. The jackets are actually consuming way more than 20 times the overhead resources of t-shirts, but the allocation doesn't reflect that. So the company prices t-shirts high, thinking they need to cover that $5 overhead, and loses sales to competitors while pricing jackets low, thinking $100 overhead is enough, and losing money on every sale. It's like splitting the dinner bill equally when one person had water and salad, while another had steak and 3 cocktails. Mathematically correct, ethically questionable, definitely causing problems. Poor allocation particularly hurts in competitive markets where pricing matters. If Tesla's overhead allocation made Model 3s look more expensive to produce than they actually are, they might price them too high and lose market share to competitors. If it made Cybertrucks look cheaper than reality, they might price them too low and lose money on every sale. Though, let's be honest, Cybertruck buyers would probably pay any price for that angular flex. This isn't theoretical. Companies have gone bankrupt because their cost accounting led them astray. They thought they were making money because their allocation system was broken. It's like thinking you're rich because you haven't checked your credit card statement in 3 months. The illusion only lasts until reality hits. The cascading effects of poor allocation are actually insane when you think about it. Bad allocation leads to bad product costs, which leads to bad pricing, which leads to bad product mix decisions, making more of the wrong things, which leads to bad capacity decisions, investing in equipment for unprofitable products, which leads to bad strategic decisions, entering markets you can't compete in, which ultimately leads to bad financial results, and confused investors wondering why the company is failing despite profitable products. It's a domino effect of wrong decisions, all stemming from that initial allocation choice. When Polaroid failed to properly allocate the overhead costs of instant film development to their cameras, they underpriced cameras thinking film sales would compensate. When film sales dropped due to digital photography, they realized too late that cameras had been unprofitable all along. The allocation wasn't just wrong, it was strategically fatal. This is why modern companies spend millions on cost accounting systems, and why consultants make bank-fixing broken allocation systems. Get the allocation right, and you can make informed decisions. Get it wrong, and you're basically running your business blindfolded while juggling chainsaws. Managerial Perspective, Part 2, Choosing Your Allocation Weapon. Allocation bases and cost drivers are like choosing your character in a video game. Pick the wrong one and you're about to have a bad time. The allocation base should ideally be a cost driver, something that actually causes overhead costs to increase. It's like understanding what actually makes your Uber expensive. Is it the distance, miles, the time, minutes, or the demand, surge pricing? Pick the wrong driver, and your cost system gives you garbage information. If you use direct labor hours, but your factory is mostly automated, you're like that person using a flip phone to take Instagram photos. Technically possible, but missing the point entirely. Common allocation bases each have their own vibe and work better in different situations. Direct labor hours work great for labor-intensive operations where humans are doing most of the work. Think custom furniture making, artisan anything, or your local coffee shop, where baristas actually make drinks instead of pushing buttons. Machine hours make sense for automated operations where robots are doing the heavy lifting. Tesla's Gigafactory, Amazon's fulfillment centers, or any modern manufacturing where humans basically babysit machines. Direct labor cost is percentage-based, which sounds sophisticated but can create weird incentives. Pay workers more, allocate more overhead, even if they're not using more resources. Some companies use direct material cost, which makes sense if materials drive complexity, but falls apart if you use expensive materials that are actually simple to process. It's like choosing how to split a group dinner check by number of people, by what each person ordered, by who drank alcohol, or just making the person with the job pay for everyone. The problem is that most overhead costs are driven by multiple factors, not just one. Electricity usage might be driven by machine hours, supervisor time might be driven by number of setups, quality control might be driven by product complexity. Using just one allocation base is like describing a person using only their height. Accurate but incomplete. This is why some companies have moved to activity-based costing ABC, using multiple drivers for different overhead costs. It's more accurate but also more complex, like switching from Instagram filters to actual Photoshop. Boeing probably uses different allocation bases for different departments. Machine hours in automated assembly, labor hours in custom interior work, number of parts in inventory management. Each base chosen because it best reflects what drives costs in that area. The strategic implications of allocation-based choice are low-key massive. Choose wrong, and you might exit profitable markets thinking they're unprofitable, or double down on losers thinking they're winners. When Gillette used labor hours to allocate overhead, their simple razors looked profitable, and complex ones looked expensive. When they switched to machine time, they realized the opposite was true. Simple razors were barely breaking even because they consumed tons of machine time, while complex razors were gold mines because complexity didn't add much machine time. This completely changed their strategy, leading to the parade of increasingly complex razors we see today. Seriously, how many blades do we need? The choice of allocation base isn't just an accounting decision. It's a strategic decision that affects pricing, product mix, investment, and competitive positioning. It's like choosing your major. Seems like just one decision, but it cascades into everything else. Companies that get this right have accurate cost information that drives good decisions. Companies that get it wrong are essentially navigating with a broken GPS, confidently driving toward a cliff while the system says, continue straight for 800 miles. Ethical considerations when numbers become lies. Let's talk about the dark side of overhead allocation, the pressure to distort numbers to make things look better than they are. It's giving Instagram versus reality energy, except instead of edited photos, it's edited financial statements. Managers face constant pressure to show profitability, meet targets, and justify their existence. An overhead allocation is a surprisingly easy place to manipulate numbers. Change the allocation base, adjust the predetermined rate, classify costs differently, and suddenly that unprofitable division looks like a winner. It's financial Photoshop, and unlike actual Photoshop, it can land you in federal prison. Ask the Enron executives how that worked out. The pressure points are everywhere in job order costing. Sales managers want lower product costs so they can compete on price. Just allocate less overhead to my products. Production managers want their efficiency metrics to look good. Don't charge my department for that overhead. Division managers want to hit their profit targets for bonuses. Can we push some overhead to next quarter? It's like group project dynamics where everyone wants credit but nobody wants blame, except with millions of dollars in potential fraud charges. The IMA, Institute of Management Accountants, and AACSB, the business school accreditation people, emphasize integrity because they've seen what happens when accountants lose it. WorldCom allocated regular expenses as capital investments to inflate profits. Waste Management changed depreciation estimates to reduce overhead. These weren't accidents. They were deliberate manipulations using the flexibility in overhead allocation. The ethical principles for overhead allocation seem obvious, but are constantly violated. Integrity means reporting costs accurately, even when it makes you look bad. Objectivity means choosing allocation bases based on economic reality, not desired outcomes. Confidentiality means not sharing cost information that could be used for price fixing. Yes, that happens. Competence means actually understanding what you're doing, not just following orders or copying last year. It's like academic integrity. Everyone knows not to cheat, but the pressure and opportunity create temptation. The difference is that accounting integrity violations don't just get you expelled. They can destroy companies, eliminate jobs, and wipe out retirement savings. When Arthur Andersen helped Enron hide costs through creative allocation and classification, they didn't just lose their CPA licenses. The entire firm collapsed. 85,000 people lost their jobs, and the accounting profession lost credibility that took years to rebuild. The safeguards against allocation manipulation include documentation, explain why you chose that base, consistency, don't change methods just to hit, targets, transparency, disclose your methods, and review, have someone check your work. It's like having a friend proofread your dating profile. They'll catch the obvious lies you're telling yourself. Modern companies have internal controls, audit committees, and external auditors, all reviewing allocation decisions. But ultimately, it comes down to individual integrity. When your boss asks you to revisit the overhead allocation to make the numbers work, that's your moment of truth. Do you maintain integrity and push back, or do you become part of the problem? The IMA's ethics hotline gets thousands of calls annually from accountants facing these dilemmas. The right answer is always integrity, even when it costs you personally. As Warren Buffett says, it takes 20 years to build a reputation and 5 minutes to ruin it. In overhead allocation, those 5 minutes usually involve someone saying, "What if we just allocated it differently?" Followed by someone else not saying, "No, that would be wrong." Don't be either of those people. Plantwide versus departmental rates, the accuracy versus simplicity trade-off. Plantwide versus departmental overhead rates is basically the accounting equivalent of one-size-fits-all versus custom-tailored. One is simple but might not fit right. The other is precise but requires more effort. A plant-wide rate uses one POHR for the entire factory, like having one WIFI password for your entire apartment complex. It's simple. Everyone uses the same rate, and it works fine if your factory is basically doing similar things throughout. But if your factory has wildly different departments, some using expensive robots, others using skilled craftspeople, a plant-wide rate is like charging everyone the same rent, regardless of apartment size. Someone's getting screwed, and someone else is getting a deal. Departmental rates recognize that different departments have different cost structures and should have different overhead rates. It's like how different floors of a Vegas hotel have different prices. The penthouse costs more than the basement, even though they're in the same building. A company might have a machining department with huge equipment costs, high overhead rate, an assembly department with mostly labor, medium overhead rate, and a packing department with minimal overhead, low rate. Using departmental rates, a job that spends most of its time in packing doesn't get unfairly burdened with machining's expensive overhead. It's more accurate, more fair, and more complicated, the accounting trinity. The simplicity of plant-wide rates is genuinely attractive, especially for smaller companies or those with relatively homogeneous operations. If you're running a small bakery where everything goes through the same ovens and decorating stations, a plant-wide rate works fine. It's like how your local coffee shop charges the same markup percentage on all drinks. Simple, consistent, good enough. The calculation is straightforward. Total overhead divided by total allocation base. Implementation is easy, one rate to rule them all. And everyone understands it. When In-N-Out Burger uses a plant-wide rate for their restaurants, it works because every location is essentially identical. Same menu, same processes, same everything. Simplicity has value, especially when the added accuracy of departmental rates wouldn't change any decisions. But departmental rates become necessary when departments are significantly different, which is basically every modern manufacturing company and most service companies. When Boeing builds planes, the engineering department, fabrication department, assembly department, and testing department have vastly different cost structures. Using one plant-wide rate would be like using the average temperature for the entire year to decide what to wear each day, technically a number, but useless for decisions. Tesla's battery production probably has a different overhead rate than their final assembly, which has a different rate than their software development. Each department gets its own POHR based on its own overhead costs and its own allocation base. More accurate? Absolutely. More work? Also absolutely. It's the classic trade-off between accuracy and effort, like choosing between estimating your taxes and actually calculating them properly. One is easier but might cost you money. The other takes forever but gets you the right answer. Departmental example. Dixon Company's two-department drama. Let's dive into Dixon Company's departmental rate example, where they've got two departments with completely different vibes: milling, machine heavy, and assembly, people heavy. It's like having a DJ and a live band at the same party. Both make music, but their cost structures are completely different. Milling is all about those expensive machines, probably costing millions, running 24/7, consuming electricity like crypto mining operations. Assembly is about skilled workers carefully putting things together, like a very expensive adult Lego situation. Using one plant-wide rate for both would be like charging the same cover for a dive bar and a rooftop club. Technically possible, but missing the point entirely. The estimates tell the story. Milling might have $500,000 in overhead, mostly depreciation, maintenance, and power for machines, and use 10,000 machine hours as their allocation base, giving them a $50 per machine hour rate. Assembly might have $300,000 in overhead, mostly supervision, quality control, and indirect labor, and use 20,000 direct labor hours, giving them a $15 per direct labor hour rate. Notice how each department uses a different allocation base? That's because different things drive costs in different departments. It's like how Uber charges based on time and distance. But Uber helicopter, yes, that's a thing, charges based on completely different factors. Using machine hours for assembly would be stupid. They barely use machines. And using labor hours for milling would be equally stupid. The machines do the work. The beauty of departmental rates shows when you track a specific job. Job number 307 might spend 2 hours in milling. 2 times $50 equals $100 overhead. And 10 hours in assembly. 10 times $15 equals $150 overhead, for total overhead of $250. With a plant-wide rate, if we averaged everything together, maybe we'd get $25 per direct labor hour, and job number 307 would get 12 hours times $25 equals $300 overhead. That $50 difference might not seem like much, but multiply it across thousands of jobs, and suddenly you're mispricing everything. It's like those banking errors where they're off by pennies per transaction, but process millions of transactions. Small errors become big problems at scale. The implementation complexity is real, though. Dixon needs to track overhead separately for each department, choose appropriate allocation bases for each, calculate separate rates, and track jobs through different departments. It's like running two different accounting systems simultaneously, because you kind of are. When a job moves from milling to assembly, the cost tracking has to follow, applying different rates at different stages. It's giving multiple personality disorder, but for accounting energy. Modern ERP systems handle this automatically, but someone still has to set it up correctly, maintain it, and explain to everyone why their job costs changed when the company switched from plant-wide to departmental rates. The companies that do this well have accurate costs that drive good decisions. Tesla knows exactly how much battery assembly costs versus final vehicle assembly. Amazon knows distribution center costs versus delivery costs. This granular understanding enables better pricing, better process improvement, and better strategic decisions. The companies that don't bother, they're flying blind, possibly profitable, possibly not, definitely hoping for the best. Job 407, computation, when departments make a difference. Let's calculate job 407's cost using Dixon's departmental rates and see how this whole multiple rate thing actually works in practice. Job 407 is living its best life, flowing through both milling and assembly, accumulating overhead at different rates like it's collecting stamps on a rewards card. In milling, it uses 3 machine hours, and at $50 per machine hour, that's $150 in milling overhead. Then it moves to assembly, uses 15 direct labor hours, and at $15 per DLH, that's $225 in assembly overhead. Total applied overhead, $150 plus $225 equals $375. This job is basically taking a journey through the factory, paying different tolls at different stops. Now let's compare this to what would happen with a plant-wide rate. If Dixon had just averaged everything together, $800,000 total overhead divided by maybe 30,000 total direct labor hours, they'd get about $26.67 per DLH as a plant-wide rate. Job 407, with 18 total hours, assuming 3 hours in milling equals 3 labor hours, would get 18 times $26.67 equals $480 in overhead. That's $105 more than the departmental calculation. This job is being overcharged with a plant-wide rate because it's not machine-intensive enough to justify that averaged rate. It's like paying for bottle service when you're only drinking beer. You're subsidizing the people actually popping champagne. This difference matters immensely for pricing and profitability decisions. If Job 407 is quoted based on the plant-wide rate $480 overhead, Dixon might lose the bid to a competitor using departmental rates who can price it lower, or worse, they might discontinue Job 407, thinking it's unprofitable when it's actually making money. It's like thinking you can't afford something because you calculated wrong. The math is literally preventing you from making good decisions. When companies switch from plant-wide to departmental rates, they often discover that some products they thought were dogs are actually stars, and some stars are actually dogs. It's the accounting equivalent of finding out your favorite restaurant has been overcharging you for years. The pattern here is that machine-intensive jobs get charged more overhead in milling, while labor-intensive jobs get charged more in assembly, which actually makes sense. A job that's all machine work shouldn't carry the burden of assembly's labor-related overhead and vice versa. It's like how your gym membership shouldn't include pool maintenance if your gym doesn't have a pool. You should only pay for what you actually use. This is why companies with diverse operations need departmental rates. Apple probably uses different rates for chip fabrication versus device assembly versus retail operations. Each segment has its own cost structure, its own drivers, and its own overhead rate. Without departmental rates, cross-subsidization happens. Simple products subsidize complex ones, or automated processes subsidize manual ones. It's socialism for product costing, and just like actual socialism, it sounds fair, but creates perverse incentives. The products being subsidized look artificially profitable and proliferate, while the products doing the subsidizing look expensive and get discontinued, eventually destroying the profitability of the entire company. Departmental rates aren't just more accurate. They're essential for survival in competitive markets where pricing precision matters. Activity-based costing preview, the ultimate accuracy flex. Activity-based costing, ABC, is like upgrading from Instagram filters to professional photo editing. Way more complex, way more accurate, and way more likely to show you truths you didn't want to see. Instead of using just one or two allocation bases, ABC identifies specific activities that drive costs and uses multiple cost drivers to allocate overhead. It's recognizing that overhead isn't just one big blob of cost. It's hundreds of different activities, each with its own cost behavior. Think of it like itemizing your Spotify Wrapped, but for manufacturing costs. Not just you listened to music, but you streamed 473 times, downloaded 89 songs, created 12 playlists, and shared 234 songs, each with its own cost implication. ABC identifies activities like machine setups, quality inspections, material handling, purchase order processing, and engineering changes. Each activity gets its own cost pool and its own driver. Machine setups might be driven by number of setups, not hours. Quality inspections might be driven by number of inspections or complexity of products. Material handling might be driven by number of moves or weight moved. It's like how a real restaurant, not fast food, prices menu items. They don't just multiply ingredient cost by a standard markup. They consider prep time, cooking complexity, plating requirements, and even how much space it takes in the cooler. Every activity that adds cost gets tracked and allocated based on what actually drives that activity. The power of ABC is that it reveals hidden costs and cross-subsidizations that traditional costing misses. That simple product that looked profitable, ABC might reveal it requires 50 purchase orders for small material quantities, 20 quality inspections because of tight tolerances, and constant engineering support. Suddenly it's a loss leader. That complex product that looked expensive, maybe it's actually efficient because it's produced in large batches with minimal setups and stable specifications. It's like when you actually track your spending and realize your coffee habit isn't the problem. It's those small Amazon purchases that are killing your budget. ABC shows you where money is really going, not where you think it's going. The downside of ABC is that it's expensive and complex to implement. You need to identify all significant activities, determine cost drivers for each, track driver quantities for every product, and maintain this whole system continuously. It's like going from tracking calories to tracking every macro, micro, vitamin, and mineral. Theoretically better, practically exhausting. Many companies that tried ABC in the 1990s abandoned it because the cost of information exceeded the value. But modern technology has made ABC more feasible. When Amazon tracks every package movement, every scan, every delivery attempt, they're essentially doing ABC, whether they call it that or not. Tesla's production system probably tracks dozens of activities automatically. The data exists. It's just a matter of using it for costing. ABC isn't for everyone. If you're a small business with simple operations, it's overkill, like using a spaceship for your daily commute. But for complex operations with diverse products, ABC can be the difference between thinking you're profitable and actually being profitable. ERP and technology applications, when Excel isn't enough anymore. Enterprise Resource Planning, ERP. Systems are basically the final boss of accounting software. SAP, Oracle, Microsoft Dynamics. These aren't just programs, they're entire ecosystems that run companies. Think of ERP like your iPhone. It's not just a phone, it's your calendar, wallet, camera, social life, and apparently your entire identity at this point. Similarly, ERP isn't just accounting. It's manufacturing, sales, purchasing, HR, and everything else integrated into one massive system. When a job moves through production, the ERP is tracking materials, labor, overhead, quality, shipping, invoicing, and probably what everyone had for lunch. It's giving surveillance capitalism, but for internal operations energy. QuickBooks and similar software are like ERP's younger, more approachable siblings. Less powerful, but way easier to use. They have job costing modules that let small businesses track jobs without needing an IT department and a consulting firm to implement it. Your local contractor tracking bathroom renovations, that Etsy seller making custom jewelry, your freelance graphic designer friend who actually charges appropriately. They're all using these simplified job costing systems. It's democratizing cost accounting, making it accessible to businesses that could never afford SAP's six-figure implementation costs. These systems automatically apply overhead based on rules you set up once, like setting up automatic bill pay, but for cost allocation. Real-time dashboards are the game changer that would make old-school accountants cry tears of joy. Instead of waiting until month end to know your costs, managers can see job costs updating literally as workers clock in and materials get scanned. It's like watching your Uber approach on the map, real-time visibility into something that used to be a mystery. Tesla's factory managers probably have dashboards showing cost per vehicle updating continuously, comparing actual to standard, flagging variations, predicting final costs based on current run rates. If a job is going over budget, they know immediately, not weeks later when it's too late. It's the difference between checking your bank balance daily versus getting surprised by an overdraft notice. The integration capabilities are honestly insane. When a worker scans their badge, it updates their time card, charges labor to the job, applies overhead, updates the job cost sheet, feeds into project management, triggers milestone billing, and probably sends a notification to 3 managers who all think they need to know everything. When materials get requisitioned, the system updates inventory, charges the job, checks reorder points, maybe even automatically orders more from suppliers. It's all connected, like how every app on your phone somehow knows your location, your contacts, and your shopping history. The downside is complexity and cost. Implementing ERP is like planning a wedding that never ends and costs more than a house. But for companies serious about cost management, it's essential. The companies still using Excel for job costing are like people still using flip phones. It works, but they're missing out on so much capability. Though honestly, Excel warriors can do amazing things with pivot tables and macros, building DIY job costing systems that would impress anyone. The key is matching your technology to your needs. Don't buy a Ferrari if you just need to get to campus, but don't try to race in a Prius either. Interactive class exercise, your turn to cost. All right, time to put your money where your mouth is, or more accurately, put costs where they belong. Here's your exercise. Job number 2025, we're manifesting the future, uses $500 in direct materials. 20 direct labor hours at $25 per hour, and we're applying overhead at $18 per direct labor hour. Calculate the total job cost. I'm giving you 30 seconds, which is generous because this should take 10 seconds if you've been paying attention, and 3 minutes if you're using your phone calculator because you can't do mental math anymore. No judgment, calculus killed my mental math too. Let's work through this together, and by together, I mean I'm going to do it while you pretend you got the same answer. Direct materials, $500. That's given, no calculation needed, though in real life someone probably requisitioned $510 worth and returned $10, causing 3 journal entries and confusing everyone. Direct labor, 20 hours times $25 per hour equals $500. Nice. The materials and labor are equal, which never happens in real life, but makes our math prettier. Applied overhead, 20 hours times $18 per hour equals $360. Notice how overhead is less than labor cost? That's unusual in modern manufacturing, but realistic for service businesses or labor-intensive operations. Total job cost equals $500 DM plus $500 DL plus $360 applied MOH equals $1,360. If Job 2025 produces 10 units, the unit cost is $136. If it produces 100 units, unit cost is $13.60. This is why knowing the quantity matters. The same total cost gives vastly different unit costs depending on output. It's like splitting an Uber, same total cost, but the per person cost depends on how many people you squeeze into that Corolla. If you're pricing based on unit cost plus markup, getting the quantity wrong could mean the difference between profit and why is our bank account negative? The real-world application of this calculation happens thousands of times daily in businesses everywhere. Every quote, every bid, every pricing decision starts with this basic calculation. When your tattoo artist quotes you $500 for that sleeve, they did this calculation, probably in their head. Materials, ink, needles, aftercare, plus labor, their hourly rate times, estimated hours, plus overhead, shop rent, equipment, insurance allocated somehow, equals cost. Then add markup for profit. When Boeing bids on a military contract, same calculation, just with more zeros and probably a team of accountants instead of one artist. The exercise seems simple, but it's the foundation of job order costing. Master this, and you understand how businesses determine if they're making money. Mess this up, and you're that business on Kitchen Nightmares wondering why you're losing money despite being busy. The math has to math, or the business doesn't business. Job cost sheets as subsidiary ledger, the detailed receipts. Job cost sheets aren't just random forms floating around. They're the subsidiary ledger for work in process inventory, which is accountant speak for the detailed backup that proves our numbers aren't made up. Think of it like your detailed Spotify data backing up your wrapped summary. The total might say 50,000 minutes, but the detailed data shows exactly which songs, when, how many times. The WIP account on the balance sheet might show $1 million, but the job cost sheets show job number 101 has $50,000, job number 102 has $75,000, and so on, all adding up to that million. Without this subsidiary detail, the balance sheet number is just a guess, like estimating your net worth without actually adding up your accounts. The relationship between job cost sheets and the general ledger is like the relationship between your individual Instagram posts and your profile grid. The posts are the detail. The grid is the summary. Every transaction that hits WIP inventory has corresponding detail on job cost sheets. Debit WIP for materials. Better be requisition forms posted to specific job cost sheets. Debit WIP for labor. time tickets posted to jobs, debit WIP for overhead, applied based on actual activity to specific jobs. The job cost sheets are the receipts, the proof, the show your work that math teachers always demanded. Auditors love this stuff because they can trace from the general ledger to the subsidiary ledger to the source documents, following the paper trail like forensic accountants on CSI accounting. Not a real show, but would probably be more accurate than most crime dramas. The reconciliation process is where things get spicy. At any point, the sum of all open job cost sheets should equal the WIP inventory balance. If they don't match, something's wrong. Maybe a job wasn't recorded, maybe overhead was applied incorrectly, maybe Kevin from accounting made another oopsie. It's like when your bank balance doesn't match your mental math. Either you forgot about a transaction or the bank made an error. Spoiler, it's usually you. Companies do this reconciliation monthly, sometimes daily for critical operations. Boeing probably reconciles their aircraft job cost sheets to WIP daily, because when each job is worth $100 million, you don't want surprises. The subsidiary ledger function becomes crucial for financial reporting and decision-making. When management wants to know what's in WIP, they don't just want a total, they want details. Which jobs are almost done? Which are barely started? Which are over budget? The job cost sheets tell these stories. It's like how Netflix doesn't just track total viewing hours. They track what you're watching, when you stop, what you skip, building a detailed picture of viewer behavior. Companies use job cost sheet data to identify slow-moving jobs. Why is job number 404 still in WIP after 6 months? Over budget jobs? Job number 505 is already at 150% of estimated cost. And profitability patterns, jobs for customer A are always profitable. Customer B always complains and costs extra. This isn't just accounting, it's business intelligence. The subsidiary ledger of job cost sheets transforms work in process from a mysterious blob of cost into a detailed map of production activity, enabling management to actually manage rather than just hope for the best. Reporting applications, from cost sheets to financial statements. This is where job cost sheets graduate from internal documents to the source data for actual financial statements that investors see. The balance sheet's work in process inventory, that's the sum of all incomplete jobs. Finished goods inventory, completed jobs waiting to be sold. Cost of goods sold on the income statement, jobs that were sold during the period. It's like how your individual Uber rides eventually show up on your credit card statement. The individual transactions aggregate into the reported numbers. Job cost sheets are the atomic level of cost data that builds into the molecular level of financial statements. Without accurate job cost sheets, financial statements are basically fiction, which is fine for creative writing, but problematic for SEC filings. When a job is completed, its cost sheet total transfers from work in process to finished goods inventory on the balance sheet. It's like when your Amazon order goes from preparing for shipment to shipped. Same cost, different category. Job number 789 might accumulate $10,000 in cost while in production sitting in WIP, then move to finished goods when complete, still $10,000, just relocated on the balance sheet. When it sells, that $10,000 flows to cost of goods, sold on the income statement, where it gets matched against revenue to calculate gross profit. This flow from WIP to FG to COGS is the life cycle of product costs, and job cost sheets document every step. It's financial storytelling, and job cost sheets are writing the first draft. The income statement impact is where job costing really shows its value. COGS isn't just some number companies make up, it's the actual cost of specific jobs sold during the period. If Tesla sells 1,000 Model 3s, COGS is the sum of those 1,000 specific job costs, not an average or estimate. This matching of specific costs to specific revenues gives accurate gross margins, which investors obsess over. A 30% gross margin means something when it's based on actual job costs. It means nothing if it's based on estimates and allocations that might be fantasy. This is why companies with job order costing can explain margin variations. Margins dropped because we sold more customized units with higher costs versus margins dropped because reasons. The audit trail from job cost sheets to financial statements is beautiful if you're into that sort of thing, and after this lecture, you might be. External auditors can pick any number on the financial statements and trace it back through the accounting system to individual job cost sheets, then to source documents like time cards and material requisitions. It's like being able to trace your Spotify Wrapped back through your daily history to individual song plays at specific times. This traceability is why job order costing companies often have cleaner audits. The documentation is comprehensive. When PwC audits Apple's financial statements, they're not just trusting the inventory numbers. They're testing the job costing system, sampling job cost sheets, verifying costs, and tracing transactions. The job cost sheets aren't just internal management tools. They're the foundation of external financial reporting. Without them, you can't explain what's in inventory, what COGS represents, or why margins changed. With them, you have a complete financial narrative from individual transaction to published financial statement. It's the accounting equivalent of showing your work in math class, except the stakes are billions of dollars and potential securities fraud charges. Overapplied overhead, when estimates meet reality. Overapplied overhead is what happens when your predetermined overhead rate meets actual results and they disagree about everything, like your GPS estimate meeting actual traffic. Remember that POHR we calculated at the beginning of the year based on estimates? Well, surprise, estimates are usually wrong. If we applied too little overhead, underapplied, COGS needs to increase because products cost more than we thought. If we applied too much, overapplied, COGS decreases because we overcharged products for overhead. It's like when you budget $200 for textbooks, but actually spend $400 underapplied, or when you budget $500 for going out, but stay home studying and spend $50 overapplied, also lies. Nobody studies that much. Let's say Yost Precision Machining used their $25 per hour POHR all year, applying overhead to jobs faithfully. Year end comes, and actual overhead was $1,050,000, not the estimated $1 million. They also used 42,000 direct labor hours, not the estimated 40,000. If they applied 25 times 42,000 hours equals $1,050,000, they exactly applied the right amount. Congrats, they're overhead psychics. But usually, applied overhead doesn't equal actual overhead. Maybe they applied 25 times 38,000 actual hours equals $950,000, but actual overhead was $1,020,000. That's $70,000 underapplied. They didn't charge jobs enough overhead. It's like splitting a dinner bill equally and then realizing you didn't include tax and tip. Someone's got to cover the difference. The adjustment typically goes straight to COGS, though technically you're supposed to prorate it between WIP, FG, and COGS based on where the applied overhead ended up. Most companies just dump it all on COGS because materiality, it's not big enough to matter, and because allocating the adjustment is annoying. It's like when you're off by $3 reconciling your Venmo transactions. Technically, you should figure out where it went. Practically, you just accept it and move on. If overhead is underapplied, you add it to COGS, making COGS higher, gross profit lower. If it's overapplied, you subtract from COGS, making COGS lower, gross profit higher. This adjustment can significantly impact reported profitability, especially if the under-overapplied amount is large. The causes of under/overapplied overhead tell you what went wrong with your estimates. Underapplied might mean actual overhead was higher than expected, inflation, unexpected repairs, that lawsuit you didn't see coming, or actual activity was lower than expected, fewer hours worked, less production, more inefficiency. Overapplied might mean actual overhead was lower, energy efficiency improvements actually worked, no major breakdowns, laid off that expensive manager, or actual activity was higher, overtime, extra shifts, unexpected efficiency. It's like analyzing why your monthly spending was different than budgeted. Did prices change, or did behavior change? Companies that consistently have large under-overapplied amounts need better estimation processes. If Tesla's consistently underapplying overhead, they're underpricing vehicles and thinking they're more profitable than reality. If they're consistently overapplying, they might be overpricing and losing sales unnecessarily. The goal isn't perfection, impossible, but reasonable accuracy, achievable. Warren Buffett's approximately right rather than precisely wrong applies perfectly here. A good POHR that's close enough beats a complex system that's still wrong. Service industry applications. It's not just manufacturing. Job order costing in service industries is like realizing your favorite restaurant is basically a manufacturing plant for experiences. They're tracking costs per table, per event, per customer, just like factories track costs per product. Law firms are the ultimate job order costing machines. Every client matter is a job, every 6-minute increment gets tracked, every photocopy gets charged, at markup prices that would make printer companies jealous. When a law firm defends a corporation in a billion-dollar lawsuit, they're tracking partner hours at $1,000 per hour, associate hours at $500 per hour, paralegal hours at $200 per hour, plus overhead for office space, research databases, and those fancy conference rooms with views that clients expect. The job cost sheet for one major case might run thousands of pages, documenting every email, every phone call, every thought about the case, billable thoughts, the ultimate capitalism flex. Accounting firms during tax season are basically job costing factories running at maximum capacity. Your simple tax return? That's a job with maybe 2 hours of staff time, 30 minutes of review, and allocated overhead for software and office costs. That corporation's international tax optimization strategy? Different job, hundreds of hours, multiple specialists, custom overhead rate for the complexity. The Big Four, Deloitte, PwC, EY, KPGM, have job costing down to a science, tracking profitability by client, by service line, by individual engagement. They know exactly which clients are profitable, keep them happy, which are break even, try to raise fees, and which are losses, fire them or fix them. It's like how Netflix knows which shows are worth renewing based on viewing costs versus subscriber retention. Data-driven decisions based on job costs. Hospitals are secretly some of the most complex job costing operations on the planet. Every patient is a job, and the range of complexity is insane. Someone comes in for a flu shot, simple job, predictable cost. Someone comes in for a heart transplant, complex job with materials, the heart, which costs around $150,000 just for the organ, direct labor, surgeons, anesthesiologists, nurses, and overhead, operating room time, ICU stay, equipment. The job cost sheet for a major surgery includes everything from the $50 aspirin, hospital pricing is wild, to the $10,000 per hour operating room overhead rate. Insurance companies negotiate based on these job costs, which is why your emergency room visit for a sprained ankle costs $3,000. You're being allocated overhead for all that expensive equipment and specialists you didn't use but that need to exist for real emergencies. Even unconventional service businesses use job order costing. Your tattoo artist tracks time and materials per client. Your wedding planner costs out each event separately. That influencer you follow? They're tracking costs per sponsored post, photography, editing, posting time, engagement management. OnlyFans creators, we're going there, track costs per custom request versus general content, applying different overhead rates for different service levels. Music production is all job order costing. Each song is a job, accumulating studio time, producer fees, featured artist costs, mixing, mastering. When Drake records an album, each track has its own job cost sheet. God's Plan might have cost $100,000 to produce, while In My Feelings cost $50,000. And this information drives decisions about singles, music videos, promotion. The music industry's shift from album sales to streaming has made job costing even more critical. They need to know if a song's streaming revenue justifies its production cost. Service industries prove that job order costing isn't just for factories. It's for any business where customization creates cost variation, which in today's economy is basically everyone except maybe utilities and commodity producers. Preview of process costing, the mass production alternative. Process costing is job order costing's opposite twin. Instead of tracking costs by individual job, you track costs by process or department and average them across identical units. It's like the difference between custom tailoring, job order, and fast fashion, process. One tracks each piece individually, the other just cares about average cost per unit. Process costing is for continuous production of homogeneous products, oil refining, chemical production, food processing, beverages, basic textiles. Every gallon of gasoline from ExxonMobil is essentially identical, so tracking each gallon individually would be insane. Instead, they track total costs for the refining process and divide by gallons produced. It's giving mass production energy versus job orders, artisanal craft energy. The key difference is that process costing accumulates costs by department or process for a time period, then calculates average cost per unit. Coca-Cola doesn't track the cost of each bottle. They track the cost of running the bottling process for January, then divide by bottles produced. It's like calculating your average cost per meal instead of tracking each meal separately, useful for budgeting, but loses individual detail. Process costing is simpler in concept, but gets complicated with partially completed units. Work in process costing is a nightmare of equivalent units calculations. When Frito-Lay makes Doritos, they're tracking costs for the mixing process, the cutting process, the frying process, the seasoning process, and the packaging process, then averaging across millions of identical chips. The choice between job order and process costing depends on production characteristics, not company preference. Tesla uses job order costing for custom configurations, but might use process costing for standard battery cell production. A bakery might use job order for custom cakes, but process costing for standard bread loaves. It's not about company size or industry. It's about production homogeneity. If products are unique enough that customers care about specific units, use job order. If products are so similar that customers just grab any unit off the shelf, use process. It's like choosing between tracking individual Instagram posts' performance versus just looking at average engagement. Depends on whether individual units matter. Some companies use hybrid systems combining both approaches. A clothing manufacturer might use process costing for basic white t-shirts, but job order costing for custom printed shirts. A brewery might use process costing for their standard lager, but job order for limited edition craft batches. It's like how you might track spending differently for regular expenses, process, monthly average, versus special purchases, job order, track each one. The future is probably more hybrid systems as mass customization becomes standard. Imagine McDonald's using process costing for standard items, but job order for custom orders, automatically tracked by their ordering system. Or Amazon using process costing for warehouse operations, but job order for each customer's specific order compilation. The distinction between job order and process costing is blurring as technology enables mass customization at scale. Soon, every product might be unique, job order, but produced using standardized processes, process costing, requiring accounting systems that can handle both simultaneously. It's the accounting equivalent of having your cake and eating it too, which apparently is possible in cost accounting even if it violates the laws of cake physics. Conclusion and review. Everything comes together. We've just downloaded an entire framework for understanding how businesses track costs for customized products and services, and honestly, you now know more about job order costing than most people in business. Let's connect all these dots one final time. We started with predetermined overhead rates, the fortune-telling formula that lets companies assign overhead costs in real time, instead of waiting until year-end to figure out if they made money. That POHR, which still sounds like a Pokemon, but is actually the key to modern cost accounting, enables every other calculation we learned. It's the interest rate of the costing world, one number that affects everything else. You've learned to compute it, apply it, and understand why it's never perfect, but always necessary. We trace the journey of costs from raw materials through work in process to finished goods to cost of goods sold, following job cost sheets like financial breadcrumbs through the accounting forest. You now understand that direct materials and direct labor are the easy part. They're traceable, measurable, and honest about where they belong. Overhead is the chaos agent, requiring allocation based on some logical but ultimately arbitrary base. It's the group project member of costs, necessary, contributing something important but difficult to assign, fairly to specific outputs. The choice between plant-wide and departmental rates isn't just technical, it's strategic, affecting pricing, profitability analysis, and competitive positioning. Get it right, and you're making informed decisions. Get it wrong, and you're navigating with a broken compass. The real-world applications we explored show this isn't just textbook theory. From Boeing's aircraft to your local tattoo artist, from Tesla's Gigafactory to Drake's recording studio, from law firms billing $1,000 per hour to hospitals charging $50 for aspirin, job order costing is everywhere customization exists. The ethical considerations remind us that with great costing power comes great responsibility. The ability to manipulate overhead allocation for personal gain versus the integrity to report costs accurately even when it hurts. The technology evolution from paper job sheets to ERP systems shows how digital transformation isn't just about efficiency. It's about visibility, accuracy, and real-time decision-making that wasn't possible when accountants were literally counting beans. You're walking away with more than formulas and concepts. You've got a new lens for seeing business operations. Next time you order something custom, get a tattoo, hire a lawyer, or even watch a Netflix original, you'll understand the costing system behind it. When companies report earnings and analysts discuss gross margins, you'll know those numbers come from job cost sheets and predetermined overhead rates. When you're in your career making pricing decisions or evaluating profitability, you'll remember that overhead allocation choices have real consequences. The math has to math, but more importantly, the logic has to logic. Job order costing isn't just about calculating costs. It's about understanding the economic reality of customization in modern business. You've learned not just how to calculate job costs, but why they matter, how they flow through financial statements, and what happens when they're wrong. That's not just accounting knowledge, that's business intelligence. Whether you become a CFO, start your own business, or just want to understand why custom things cost so much, you now have the framework to analyze job costs like a pro. The overhead has been allocated, the jobs have been costed, and your understanding has definitely appreciated. No cap, you're ready to take this knowledge and apply it, pun absolutely intended, to whatever career path you choose.